Your investors just handed you a reporting package that will consume 40 hours of your finance team's time every single month, and they expect you to start delivering the day you close. Now, most growth stage sponsors raising 10 million or above accept these templates without realizing they were never designed for their deal size or operational capacity. Here's what's happening. Institutional investors circulate broad boilerplate reporting requirements as starting points, not final positions, but founders treat them like carved in stone mandates. The result is sponsors entering post-close with monthly financial packs, bespoke KPI dashboards, and recurring narrative memos that consume more bandwidth than actual business operations. Now, according to the Center for Audit Quality's 2025 Institutional Investor Survey, 91% of institutional investors identified audited financial statements as their primary information source, and 96% say current reporting already gives them what they need. So why are you being asked to build custom data infrastructure they won't even use? So this video is for growth stage sponsors raising $10 million or above who want to negotiate lighter reporting obligations before signing definitive documents. If you're raising your first million or you've never closed institutional capital before, then this isn't for you. We're talking about sophisticated negotiation tactics that assume you understand term sheets and have closed deals before. Now, growth stage sponsors raising between 10 million or more can successfully negotiate higher reporting obligations before signing definitive documents without undermining investor confidence. The NVCA model legal documents October 2025 update set the institutional baseline, okay? Quarterly unaudited financials within 45 days, annual audited financials within 120 days, monthly financials only upon request, and no obligation to create new information beyond what is reasonably maintained. That's the market standard. Most sponsors are being asked for significantly more. Here at IRC Partners, we've reviewed over 200 growth stage reporting packages in 2025 alone and found the same pattern. Investors start from broad templates that weren't designed for your deal size or finance team's capacity. Now, these templates often originate from $500 million platform deals with dedicated finance teams and full-time controllers. The negotiation window exists because reporting obligations are information rights, not management rights. You can scope them without undermining investor confidence. Most sponsors don't just realize this conversation is available, but there's a specific way to frame the ask that makes lighter reporting sound stronger, not weaker. Information rights gives investors visibility into economics and material events. Management rights effectively give investors operational oversight. Now, most sponsors miss when reporting terms cross that line. An obligation to produce custom analysis on request isn't information visibility, it's management oversight without the label. Same with requirements to prepare bespoke projections on investor demand or provide recurring narrative updates that function as standing operational oversight. Now, here's the practical test. If the reporting obligation requires you to think differently about how you run your business, it's crossed into management territory. True information rights let you share what you already know and track in your normal operations. We see this confusion most often in bespoke KPI schedules. Investors will ask for custom metrics that require new data infrastructure, then frame it as basic transparency. But requiring you to build new systems to satisfy investor curiosity is management oversight disguised as information access. The distinction matters because information rights are standard and expected, while management rights require different negotiation positioning and often different economic terms. Now, let's look at the specific baseline that institutional investors actually accept. NVCA model legal documents October 2025. That update provides your negotiation anchor. It confirms that reporting obligations should be appropriate for company stage and deal size with specific timing benchmarks. Quarterly unaudited financials within 45 days, annual audited financials within 120 days, monthly financials available on request, not on a recurring schedule. No obligation to create new information beyond what is reasonably maintained in normal operations. This isn't theoretical guidance, it's the institutional standard that sophisticated investors help write. When an investor asks for monthly recurring financials, weekly flash reports, or bespoke KPI dashboards, they're asking for more than the institutional baseline. The genius of the NVCA framework is that it ties reporting obligations to operational reality rather than investor preferences. You're not required to build new systems to satisfy investor curiosity. You're required to share what you already maintain for business purposes. Here at IRC Partners, we use this framework as the starting point for every reporting negotiation. It gives sponsors credible market language to push back on overreaching requests without sounding defensive or secretive. But knowing the baseline isn't enough. You need to understand what investors actually use to make decisions. Now, according to the Center for Audit Quality's 2025 Institutional Investor Survey, 91% of institutional investors identify audited financial statements as their primary information source, and 96% say current reporting already gives them what they need. This data destroys the premise behind most heavy reporting packages. If investors are getting what they need from audited financials and standard quarterly reports, why are they asking you to produce monthly narratives and custom dashboards? The answer is usually template momentum, not analytical necessity. Institutional investors circulate the same reporting templates across deals of different sizes and stages because it's administratively easier than customizing requirements to specific situations. But you're not required to accept administrative convenience as your operational burden. When 96% of investors say they already getting what they need, additional reporting requests become harder to justify as essential rather than preferential. We use this statistic in every negotiation because it reframes the conversation. Instead of defending why you want less reporting, you're asking investors to justify why they need more than what 96% of their peers find sufficient. The key is distinguishing between decision useful disclosure and administrative drag. A reporting package becomes too heavy when it requires the sponsor to build new systems, produce custom dashboards, or generate recurring narrative output that does not already exist in the normal course of operations. Decision useful disclosure provides information that materially improves investor visibility into economics, risk, or variance. Now, administrative drag requires effort without improving investor decision-making. The right test for any reporting line item is whether it passes the decision useful standard. Heavy obligations cluster in three places: bespoke KPI schedules that require new data infrastructure, recurring narrative memo requirements that function as standing management updates, and broad ad hoc request clauses with no defined scope or frequency. The SEC's 2026 materiality guidance supports this framework. Disclosures should be decision useful and tied to investor economics, not broad administrative production. That principle applies to private market reporting negotiations, not just public company filings. Here at IRC Partners, we walk through every line item in a reporting package and apply this test. If it doesn't improve investor decision-making about economics or material risk, it's administrative weight and can be negotiated down or eliminated. But the framing of your negotiation determines whether lighter reporting sounds stronger or weaker to investors. Sponsors who lead with "we want less reporting" invite skepticism. Sponsors who lead with "we want reliable, consistent reporting scoped to what investors actually use" are making a quality argument, not a convenience argument. First framing move: anchor to stage and deal size. A growth stage sponsor raising $10 million or more is not a publicly traded platform. The reporting package should reflect that reality, and the NVCA guidance explicitly supports stage-appropriate obligations. Second, offer a scoped alternative, not just an objection. Come to the conversation with a counter package that preserves core economics reporting, key variance, commentary, and exception triggers. Investors respond better to credible alternatives than to red lines with no substitute. Now, third, lead with reliability. A lighter package you can deliver on time every quarter builds more trust than a heavy package that produces inconsistent or delayed output because your finance team is overwhelmed. Fourth, separate recurring obligations from ad hoc rights. Investors often need specific information in particular circumstances. Narrowing ad hoc requests by trigger and topic preserves investor protection while giving you defined operational boundaries. These framing moves keep the negotiation commercial rather than defensive, and they position lighter reporting as a quality improvement rather than a convenience request. And once the framing is right, you can work through the package line by line and identify where lighter alternatives preserve investor visibility without adding operational strain. Instead of monthly full financial packs on a recurring schedule, offer monthly flash metrics or financials on request only. Core trends remain visible. Full packs are available when needed, but your finance team isn't locked into monthly production cycles. Instead of quarterly financials plus mandatory narrative memos, provide quarterly unaudited financials plus variance commentary on material items only. Investors see economics and risk without standing memo obligations that consume management bandwidth. Instead of bespoke KPI dashboards on custom investor schedules, share existing internal KPIs quarterly tied to investor economics. Investors see what drives the deal without forcing you to build new deal infrastructure. So instead of recurring narratives, updates on operations, offer exception reporting triggered by defined material events. Investors get timely notice of what matters without standing operational oversight. Here at IRC Partners, we've seen sponsors successfully negotiate these substitutions across institutional capital sources without losing credibility or delaying closes. But verbal agreement on lighter terms isn't enough to protect you. Reporting obligations can expand in side letters, annexes, defined terms, and diligence request list that sponsors review separately from the main agreement. A clean main clause doesn't guarantee a clean final package. We tracked document drift patterns and found 5 places where lighter terms get undermined during final review. Side letters that expand reporting beyond the main agreement. Defined terms that broaden what counts as required information. Diligence annexes that create standing obligations disguised as one-time requests. Ad hoc request clauses with no scope, trigger, or frequency limits. Obligations to create new information systems beyond what's reasonably maintained. Your pre-signed checklist. Confirm the reporting schedule is captured in one place with cadence, content, timing, and carve-outs listed explicitly. Check side letters and annexes for obligations that expand the main clause. Look for defined terms that broaden what counts as required reporting. Identify any obligation to create new information beyond existing operations. Confirm ad hoc request rights have defined scope, trigger, and frequency limits. The best time to negotiate lighter reporting is before legal language gets embedded across multiple documents. Once terms are hardened in main agreements, side letters, and defined term schedules, changing them becomes a late-stage concession rather than a commercial conversation. Most founders don't realize this negotiation window exists, or they assume template terms are non-negotiable. Neither assumption is correct. The difference between sponsors who escape heavy reporting burdens and those who don't comes down to understanding which terms to challenge, how to frame the challenge, and doing it before the document stack hardens. Now, most founders don't lose the raise because of the pitch. They lose because the structure was wrong before the first investor call. If your raise is $5 million or above and you want to know if your deal is institutionally ready before you sit across the table from an LP, there'll be a link in the description below to set up a call with our team. We review your structure, your terms, your capital stack before you walk into the room and determine the feasibility of your raise.